Okay, this chapter we deal with partnerships. And before we get into the accounting of partnerships, we got to look through and look at some of the characteristics that they have and see how they put together and some of the rules. And a partnership is just two people coming together, or two or more people coming together to start a business, right? So the concept of voluntary association, that just means that you're coming into this by choice, you're not being coerced, that kind of stuff, right? So two people willingly come together, two or more people willingly come together and form this partnership. Well, in a perfect world, we would have a partnership agreement, right? Now that's the contract between the partners that talks about them going into business. Contracts can be written or they can be oral. So starting a partnership is really easy. It's as simple as agreeing with somebody and shaking hands, right? And you have a partnership. The problem with that is that you didn't plan anything, right? Or you didn't set anything down on paper. So I'm a firm believer that when you write this partnership agreement, you need to have people like accountants and attorneys help you out so you can talk about things like who's going to do what and who's going to contribute what and how much is this person going to work and that person going to work and how much are you going to draw out of the partnership and maybe an exit strategy for the end of the partnership. So all of those things should be laid out in the very front side of forming this partnership, right? In a perfect world, this is a written document signed by both parties that's negotiated between them, so we come to some sort of agreement. It is really the contract between the partners. The concept of limited life. Partnerships do not go on in perpetuity. When a partner dies, when somebody goes bankrupt, those kind of things, the partnership goes away and oftentimes reformed in something that looks very much the same. But they have a limited life by their very nature. The one thing they don't have that's limited is liability, right? They have unlimited liability, which means that each partner is responsible for the debts of the partnership, right? Not just their share. So if there's four people in a partnership and one guy's got money, right, he's probably going to be on the hook for the other three's debts in the event that something goes south, right? Now, we talk about co-ownership of partnership property. Assets are jointly owned by the partners, but claims on the assets are based on your capital accounts, right, or specified in the partnership agreement. Mutual agency, this goes back kind of to this unlimited liability. What mutual agency says is that all partners can enter the partnership into contracts, right? So again, any of the partners can enter the entire partnership into contracts. So if I think I need a new company car and I go buy a new Lamborghini for $250,000, the rest of the partners are on the hook for that, right? So mutual agency can be kind of a negative thing. Taxation. The beauty of a partnership is it's a pass-through entity. It's what we call a pass-through entity. So that means that the partnership itself doesn't pay taxes. Now, that doesn't mean that the entity's off the hook. It just the income passes through down to the individual partners, right? So that income passes through to the individual partners. Okay. So those are some of the characteristics of the partnership. There also, that what we talked about was just a standard partnership has been defined for forever, right? There are some newer forms of business called limited partnerships, limited liability partnerships, and limited liability companies. And they have different characteristics. Those are generally legal characteristics, right? For instance, in a limited partnerships, the general partners have unlimited liabilities and the limited partners are protected. In an LLP, a limited liability partnership, again, there is a limit to the liability, but most states are going to hold you personally responsible for all of the partnership debt. And then we have LLCs, which is a combination of partnerships and corporations, right? Some of the features of both. The thing that we need to remember for this particular class is that we're learning the accounting for these, right? Not necessarily the legal structure. The accounting for a partnership or any of these three forms of business looks exactly the same. So what we're going to do is we're going to learn how to account for a partnership. Those same concepts are going to apply to limited partnerships, LLPs, and LLCs, right? In your business law class, they'll give you a little more of an indication about these differences between these. We are going to focus really on the accounting for them. Okay. So when we're organizing a partnership, this is kind of in random order. I stole this from these PowerPoints from the book. But that's okay. It all works us towards the right end. When we think about a partnership, partners can invest both assets and liabilities into the partnership, right? We're gonna do a little example here in a bit, maybe in the next video, where we talk about how partnerships come together, how people can enter into them. Generally, assets and liabilities are recorded in an agreed upon value, fair market value, because it's essentially like the new partners selling the assets and liabilities to the partnership. Asset contributions increase the partner's capital account, just like in a sole proprietorship, right? When the guy put money into the business, assets go up, owner's equity goes up, and withdrawals from the partnership decrease the partner's capital account, right? So when you draw money out, that partner's capital account goes down. So towards that end, that means that what? Each partner has to have their own capital accounts, and they have to have their own drawing accounts, right? So we used to have capital and drawing, and now I have a capital account and a drawing account for each partner, right? For each partner. Now, if we think about it, the things we've learned still apply. If you remember that closing process, right? 4 steps in the closing process: close revenue to income summary and close expenses to income summary. Now this one talks about step 3, which was to do what? Close income summary to capital. But now I have what? I have 2 partners, and they each have a capital account. So when I close that income summary account, we have to make some decisions about how much of the income goes to each partner, right? Then the 4th step of the closing process is still what? Close drawing to each partner's capital account. Remember that we're going to have separate capital and separate drawing accounts for each partner. So there is a little bit about the introduction to partnerships. The next series of videos, we're going to go through a whole bunch of different examples of the kind of transactions that we're going to bump into to start a partnership and admit new partners and divvy up net income, and we're going to examine looking at these steps 3 and 4 in the closing process, right? And how we go about that, and what happens on liquidation. So there's still a lot to come. This was just kind of an introduction to get you comfortable with the topic of partnerships.